And today, one of my favorite people to pick the brains of is Geordie Visser. Geordie is amazing at understanding and thinking well ahead of everybody else in exactly what I look at, which is this nexus between macro, crypto, and the exponential age of technology. And so we're going to have a wide-ranging, very interesting conversation, and hopefully you'll walk away understanding a lot more than when you started. Geordie, so just for those that don't know you, just give us the 1 minute background on Geordie.
All right, I started at Morgan Stanley in a similar capacity, I guess, to you, or we ended up in the same capacity. So I started in the risk management and controllers area, and then moved into derivatives in '94. Spent almost all of the '90s in emerging markets, and then moved on to run the S&P option book for the firm before leaving, starting my own macro hedge fund. I brought that team into a multi-strategy firm called Weiss, and then I stayed there for 20 years. And now I think, again, I think I said this on our podcast, I'm kind of following you around in terms of going in the same area. And now that Weiss is closed, I have moved on to focus on helping bridge the knowledge gap that exists between traditional investors and a world that's changing, as you know, very rapidly, and preparing them for how to infuse both AI and digital assets into the way that they think, because it's just not an easy place for them to go. And the pace is moving at you, as you know, at such a fast pace that this is a fun time for me to kind of set up my own business and focus on that.
I have no idea how to even think about it. So try and frame up the magnitude, the velocity, and the ferociousness of what is happening and what is about to happen once you start putting your macro view there.
The big picture is very simple for me. There's no recession now. There's not one coming.
One sec,
Yep.
because you've changed my mind on this, and it's yet to be proven. But you stopped me dead in my tracks when I was in your office. You said, "I don't think we can have a recession anymore," and it was one of those comments that sticks in your head. You go back, and I did a lot of thinking, a lot of writing, and a lot of work on it. And I came to the same conclusion under the current construct. I don't think we can have one outside of exogenous events.
So yeah, just so to start with, and this is not a way to escape it. It's not a play on words. So people who are watching can put it in their own context if they want to debate it. So a recession for me, since there's no real definition, is the way I saw both the 1970s and the Great Depression. And the common thread between those, from hearing my grandmother and my father, is that number one, you don't have a job, and number two, you can't get a job. So let's just start that's the definition. All this mathematical garbage that people come up with, 2/4 of negative GDP, I just don't get into that. So it's kind of a phantom that people are calling for this. The second thing is, because of exponential innovation and because of the Fed, the big change that's happened since the last recession that happened through business cycles, which would be 2000, the great financial crisis, because I'm not counting the pandemic, which happened and was gone within a quarter because we shut everything down. That was a traditional business cycle. So what happens during a traditional business cycle? For you to have a recession, the banks stop lending. All of the people that have, all the major places that have debt run into trouble, and the Ponzi scheme starts to unwind, because the fiat system is a Ponzi scheme. So this is not some optimistic view. It's a Ponzi scheme. So if you have that scenario that there's never a debt side, then it comes down to the other side, which is, do the central banks have a chance to stop a cycle where you're not having a deleveraging-led situation? You're actually having people sell to get liquidity, and there's no one to take the other side. Well, that's what the pandemic was. It was a liquidity-driven recession. And what did the Fed do? They used the tools that were created in the great financial crisis. So at the same time that we had the last recession, the Fed put these tools in place. There was 700 billion of balance sheet for the Fed before the great financial crisis, and now it's at 7 point whatever trillion, coming off a peak during the pandemic. We saw what happened with SVB, which theoretically was a run on the banking system. That could have led to a deleveraging. And what did the Fed do? They found a way using those new tools. So you can't ignore the fact that the Fed was given a bazooka to deal with this. You now have the government that's bigger, but there's one other thing, and this is where you and I talked about it, and this fits in with the expansion of the most important part of the economy. The most important part of the economy is technology, innovation, artificial intelligence. So we have companies now that make up more than $10 trillion of the stock market and growing. Those companies got to those sizes where combined they were less than $1 trillion and a half dollars in 2009, coming out of the great financial crisis. That entire growth was funded through cash, meaning they've accumulated so much cash and had to not issue debt to grow to that size. We've never seen that before. So the traditional business cycle of you have a debt deleveraging, it just doesn't exist. So I don't think there's any chance of us going through that. I do think we can have slowdowns and regime changes, but not recessions.
The other reason I think that we can't is going back to your point about what the credit cycle is. Normally, it's the collateral.
Raoul elaborates on the current phase of the business cycle, emphasizing the familiar opportunity for certain markets to rebound and perform well. He notes that as the economy begins to recover, the US dollar typically weakens, creating ideal conditions for small-cap stocks, commodities, and emerging markets. These sectors often experience significant drops during downs as investors seek safety assets. In the same interview, however, Jordi Visser highlighted Bitcoin's rising appeal, pointing out that more millionaires are being created in crypto than in traditional markets. Visser emphasized Bitcoin's resilience, reaching new highs even in a bear market, and stressed its importance for populations in countries like Argentina and Brazil, where trust in banks is low. He also noted recent developments such as the introduction of Bitcoin ETFs and the growing prominence of stablecoins, indicating a broader acceptance of digital currencies. So let's watch more clips from the interview for further insights into Jordi Visser.
And if you go back to 2016, we had similar moves in the Asian currencies to start off that year as well. And again, there was the quote unquote China-US or the Shanghai-US Accord in March of 16. I think people do underestimate the coordination when things are necessary. And the fact that China did something, the biggest easing they've done, and announcing something they had not announced, which, their stock market is not as big as their property market, but I think they've started to realize that the reason that these other places, because Japan obviously has been buying equities and that's helped their stock market, your stock market needs to get local animal spirits. If you're trying to change sentiment, the stock market's really important. So I think China there probably was some coordination that went on. And if it wasn't intentional, it's still, hey, the Fed's easing, we're now free to go because the Fed can't turn around and hike. I will say, and since we did differ on this, and I'll let you go. If you asked me right now the risk for the next regime shift, I feel very, very strongly that PMIs are going higher between now and the end of the year around the globe, that will lead to a bottoming in CPI, which will happen in October, because that's when we'll get the September data, and then the year-over-year comps will start getting easier for the U.S. A bounce in the PMI will take the goods inflation higher. But there's one thing, and I sent this in a tweet, and you and I have not talked about this. One of the things I did with AI and I use it for is to say, hey, let's recreate a proxy for things. Bitcoin doesn't have a story. So I finally tweeted it today because I created a proxy for Bitcoin, and it's a certain amount of weighting of gold for liquidity, copper for AI, because you're going to need a lot of copper and we have a shortage, and copper's acted extremely well. And then Q's for what I consider to be safe, large cap investment into innovation, which is where Bitcoin is now because it's one of the largest assets in the world. It's not Cathie Wood's ARK. It's not one of these things that's less liquid. It's not a private thing. It's a big asset. And that thing broke out today. And I just think with what China did, the number one story in the world is that liquidity from the biggest money, M2 in the world. China's money supply crossed over the US in the great financial crisis. It's now twice the size. You always show your global, your GMI liquidity thing. That's predominantly China money. And the number one strengthening part of it is when their currency strengthens, which fits in with what you said, and that's what's very interesting. You wouldn't think the Chinese currency would be strengthening on the back of liquidity measures and rate cuts and their yields moving lower, but it is. And I think that's a huge liquidity boom for the world because the yuan's getting stronger and it's the biggest money supply. So
in 2016-17 crypto cycle, we didn't get a liquidity boost from the US. They were trying to hike rates and they stopped because the Chinese said, whoa, stop, right? Remember, same shit was going on. Oil price was collapsing. Everyone was like, no, stop this. You're destroying everybody. So the US just stepped aside, didn't really add liquidity. And the Chinese did this again and added as much liquidity as possible. And the Europeans and the UK after the Brexit flooded liquidity. So you don't actually need the US because, as you rightly point out, Chinese liquidity is a big deal. So the question about that I want to ask is the property sector. Okay, so let's assume the Japanese will allow Eurodollars to get into the Chinese market. Let's assume there is some reparation. It doesn't yet feel big enough for the property market. I get your point of the real estate market, but the property market is like, it's a dead weight. Do you think there's more to come? Is this the Draghi moment or not?
So I think it's the Draghi moment.
Or is this the HKMA intervening in the currency market before they did the big bazooka? Has the bazooka been fired, or are they just taking aim?
No, I think this was it, and I'll tell you why. I agree with you. So let's just start with the most powerful deflationary forces in the world that cannot be stopped. Are demographics and exponential innovation. You can't stop them. The Chinese situation for their property market, there's no way to turn that battleship. It's just, can you make it stop going down? Yes, you could get a little bit of investment side, but not without actually getting the collateral, as you mentioned, to start going higher. And the
Thanks for watching. If you buy and spend coins, check Nexo Exchange, and I'll see you in the next one.